Pick your fighter, folks. In one corner, you get Dr. Michael Burry, who sees economic troubles, a stock market collapse, mega bubbles, huge risk, doom and gloom. In the other corner, who do you have? You got Cathie Wood. She sees the recent sell-off in her growth stocks as a huge buying opportunity and thinks the different ARK funds have huge upside from here. Hundreds of %. That's what she's talked about. And so the question is, who's right when you look at this? In this video, I'm going to talk about both perspectives, trying to understand who's right. And surprisingly, I actually think they both can be. And I'll talk about why in a second. Let's dive right in. And so, understanding, first of all, Dr. Michael Burry's perspective, where he recently posted, all hype speculation is doing is drawing in retail before the mother of all crashes. He's warning folks. He's saying, hey, look, this is the retail investor that's getting involved. It's the fear of missing out parabolas. And that's what you see with the stock market going straight up. Don't resolve sideways, i.e. they crash. When crypto falls from trillions or meme stocks fall from tens of billions, Main Street losses will approach the size of countries. History ain't changed. And he's not wrong, folks. Like, this is bringing in retail interest like none before, and these meme stocks are going crazy. I mean, one example has been AMC stock, and it's gone parabolic from, mid low single digits to like $60 a share. It's just gone crazy. You could see up here, what it's done in recent days. And I even made a video on AMC talking about how it's unrivaled lunacy, talking about how the valuation doesn't make sense. Management is aware of this, and look, management isn't working towards you keeping that stock price up if you're pumping up AMC, because they're going to issue more and more shares, dilute the heck out of it, raise a ton of cash, and was very attractive valuation. But then again, this isn't about valuation. That's the key point that Michael Burry's saying. He's like, look, they're losing sight of valuation. Here it is, AMC. It's not about valuation. We got retail interest just saying, hey, I'm going to somehow stick it to the man. Little do they realize that it's a lot of hedge funds that are doing the same sort of game that they're doing, but more likely that the retail investors are going to be the ones that ultimately get burnt and hold the bag at the end. And that's a common story I hear, like, hey, Daniel, I bought this, I don't know what got into me, and now I've lost a lot. What do you think? And look, everyone has to figure out their own journey. That's why I'm trying to, speak from a point of rationality here. But going back to Dr. Michael Burry's point over here, valuations have gone crazy. I mean, this is the real yields for junk bonds. This is the lousiest type of bonds that are out there, just short of default or non-compliant bonds. And so here it is. The real return when you back out inflation is negative right now. This is the lowest it's been literally in decades. A whole generation. I mean, it's just incredible. And when you look at this, you look at how bond yields are now negative. You should expect, equity prices are driving a similar just crazy valuation, in part because bonds are in this crazy valuation right now, where you have high inflation and really high bond prices resulting in negative real rates. I mean, this is the ultimate example of just terrible risk reward, having negative real returns on junk bonds. These are incredibly indebted companies. These aren't the incredible software companies that don't need to borrow money. These are the companies that need that debt, maybe a crappy or a lousy business model, and you know what? They're just shy of bankruptcy. They're extremely levered. And then you consider the other. Okay, so we talked about Dr. Michael Burry. Now let's consider the other angle. And the other angle is you'd have Cathie Wood, who recently posted on May 21st, the rotation from growth into value stocks has strengthened this bull market. That was one of her posts. She's effectively saying, folks, this party is just getting started. And, look, you got to give credit to both of them. Dr. Michael Burry has an incredible track record. He called the great financial crisis, crushed it. And you know what? Cathie Wood from ARK, she's also crushed it. If you look over the last 5 years, her annualized return is around 46%. This is these are just mind-blowing figures since inception, over 30%. These are Hall of Fame numbers if she doesn't ultimately blow up. That's the way I think about it. If through a full cycle, both up and down, she doesn't blow up, then this is Hall of Fame numbers. But I'd argue you need to see a full sort of market cycle, and things have been pretty aggressive, in terms of stocks and people, animal spirits. And she sees continued huge upside for ARK. She talks about, she wrote a post about how ultimately deflation is more likely to prevail than inflation, and saying how growth stocks in general and innovation-driven stocks in particular should be the prime beneficiaries, i.e. the ARK funds with their various different either innovative or high-growth companies are likely to benefit. And here's a direct quote where she says, "Our price targets have not changed, and the prices have come down. Our rate of return over the next 5 years have gone up dramatically." This makes sense, like saying, look, the price, if you're doing a solid analysis, and I don't always agree with her. Like, I think her Tesla analysis, I strongly disagree with. I made a video about that. That said, there is occasional overlap in terms of things that I find interesting that her fund ultimately buys. Looking at it, she's saying, hey, the price targets have stayed the same. Price goes down. Yeah, there's more upside now. She views this as a cyclical reset bringing opportunity. Direct quotes here. So she's seeing huge upside. I think previously she commented how this price decline with ARK, and it declined, nearly 30-40%, suggested that over the ensuing 5 years, ARK could compound at 20-30% plus in the years ahead, which would be continued to be phenomenal returns in this environment. And so the question is, like, who's right? As you're considering this. And, so that's, I'm going to do a quick plug here where if this is your first time tuning in. My name is Daniel. You're watching Unrivaled Investing. Normally I try to find potential multi-baggers or stocks that I think could potentially go up hundreds or even 1,000%. But occasionally I do want to understand broadly what's going on in the market, so I'll make a video like this. So if this is the type of thing you're interested in, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey, each month, first week of the month, I call out my full portfolio, and then during the month I call out one potential multi-bagger or a stock that I think has that type of, attractive risk reward or significant upside potential. For that, you go to unrivaledinvesting.com, click on Journey, building exclusive content and an exclusive community on Discord to discuss these thoughts. So anyway, let me get back to pick your fighter. Who do you think is going to win? And as we look at this, I picked my fighters, but they're actually a little different than what you'd think. But fundamentally, they could both be right. And that's the part where I think a lot of people need to think, and that's why I'm going to bring up this example right here. This is one scenario. In every market cycle, it's going to be different, but I think there's an increasing chance that they could both be right. Not saying definitely that's going to happen, but this is how I'm starting to think about it. Where here's this quote that's worth reflecting on from Ben Graham, the father of value investing, who taught Warren Buffett. He said, "Only 1 in 100 survived the 1929 through 1932 debacle. If one was not bearish in 1925." That's a really interesting quote, saying, in the 1929 to 1932 price collapse, where the stock market fell effectively like 90%. He's saying you wouldn't have figured out to survive it unless you were already bearish in 1925, unless you got out of the game several years in advance, 4 years before this thing popped, before this thing started its collapse. And so let's actually understand the meaning of that quote. And here it is. If you go back to the 1920s, you can see the market was already up significantly over in the go-go period, the 1920s. It was an exciting time. And by 27, the market was actually quite frothy. But then, so even though the market was already pretty frothy by 1927, what happened that made it go parabolic? And what made it go parabolic was actually the Federal Reserve stepped in, and the economy and the market, once again, already frothy. Then Benjamin Strong, who ran the Fed at the time, he lowered the Federal Reserve discount rate in response to global currency fluctuations, where he wanted to make the dollar weaker. So by lowering the discount rate in 1927, when the market was already speculative, things were already frothy, that just, it was like gasoline on the fire, and that's what caused this dramatic speculative move. And it's worth understanding this in that central bankers can be off step and drive inadvertent bad actions. Inadvertent bad policies can drive wild actions such like this. And it's worth considering this because when I think who is right, and I'm considering like I'm picking my fighters, I'm actually thinking about Stanley Druckenmiller, Charlie Munger, Warren Buffett. And let me actually share why as I'm thinking about these and trying to channel them in my own investment journey. In that Stanley Druckenmiller, he's considering that, hey, there's no hikes until 2023. That's what the Federal Reserve effectively just indicated. Now that is a little up from what they previously indicated. They previously said 2024, so they do acknowledge some inflation, but 2023 is still a long time away. And he's probably reflecting on, Stanley Druckenmiller is one of the greatest of all time investors, 30% for 30 years, type of annual return without a single down year, one of the greatest, and he focuses on top-down analysis, trying to figure out what's going on with the central bankers, what are they doing, and he also looks at price action to drive his decisions. And so he's looking at this is sort of what he hasn't said this, but this is sort of what I'm anticipating he's thinking. He sees no hikes until 2023, and the Federal Reserve is continuing this obscene quantitative easing for at least the next few months. I mean, here it is. You had this 5% inflation print, and yet the Federal Reserve is still printing money to the tunes of hundreds of billions of dollars each month, buying securities with newly created money each month. And he's saying, wow, the economy's red hot. This doesn't really make any sense. But as long as the Federal Reserve is going to be out of lockstep with, not in lockstep, is out of step with the market, you can have crazy things happen with the market. And so maybe during this time, similar to what you saw in the 1920s example, you get a parabolic move. And one could argue you've already seen a large chunk of that, in 2020 leading up to maybe a peak in February of 2021. But I think he's looking at this thinking, you know what, there's a chance that these growth stocks could get bid higher. And so this is sort of my top-down guesstimate based on thinking about it. And one of the key attributes of the way he thinks, and he's called this out, is that he uses price action to make a call and sort of rebuild his thesis. He's sort of saying, well, I can have a thesis from today to tomorrow, but does the price action support it? Now, this is different than how I fundamentally invest. I'm looking for intrinsic value, and I'll talk about that in a second. Where I'm channeling I'm trying to think about Charlie Munger and Warren Buffett, but here it is, Stanley Druckenmiller, he uses price action of given securities to make a call. And today, the day after the Federal Reserve announcement, I think he's looking at the price action, particularly, you look across the board. I mentioned you want to look at Treasury securities, for example. And so, for example, and that I think is the ultimate indicator, red light, green light for the market. And interestingly enough, 20 to 30-year bond yields have actually gone down in the last day. This is despite the Federal Reserve continuing its incredible QE, but effectively acknowledging like, hey, we'll raise rates in 2023. We'll make sure we're on top of inflation. The fact that these long-term bond yields have actually gone down from the 7-year to the 30-year have actually declined since then, it does reinforce this idea that, they will ultimately raise rates and they'll get inflation under control. If the market didn't believe, global investors didn't believe, they'll get inflation under control, then these rates would have jacked higher. And so I think he's looking at this as price action, saying, this yield curve has gotten flatter. This is fine. There's a good chance here that you get this sort of blow off top potential, or where things just continue, things can go even further parabolic. But he's going to use price action to judge whether or not he's right or wrong. And just the price action for today, for example, was that, the ARK funds got a bid. And pretty much everything else, including financials, retail, everything else sort of struggled. It didn't really get a bid because you see near-term price pressures. Whereas here, you could get these speculative juices sort of pushing up these growth stocks. And that's sort of what we're seeing based on the limited data post the Federal Reserve announcement. I personally like to understand this and to see the price action and look at different sectors to sort of understand a broader market thesis. I personally use a hedging strategy if I'm wrong, if things start going against me. But this actually goes to the next component of who I'm betting on in terms of philosophies. And at the end of the day, I'm betting on intrinsic value. And so what do I mean by that? So when I think about intrinsic value, there's price of a stock, and then it's what do you think it's worth? And ideally, you're finding something where it's like, hey, the price is here, what it's worth is here, and in 5 years from now, I think the worth is going to be even here, or maybe even more. In which case, if the price just stays here, it's going to get incredibly cheap. And if the company delivers like I expect, then it's going to be a great return. And so fundamentally, it's looking at intrinsic value, trying to figure out what's this company worth. And I do a lot of example sheets, back of the envelope, thinking about the valuation. But I wonder, and I pose this as a question to you, if you can leave a comment below, I'd love to hear it, in that if you start seeing this price action reinforced, and Paul Tudor Jones called this out as well earlier this week. I also made a video about that, effectively saying, look, if the Federal Reserve ignores this risk, and effectively it looks like, risk on, which early data points suggest potentially, then you potentially get a pop in risk assets like the NASDAQ. He even said the NASDAQ can easily pop 20%. And so I'm thinking, like, looking at that, should one consider, from a portfolio management perspective, putting on some additional risk with the understanding that A, you might want to take it off if things start going south. I'd love to hear your personal journeys as you consider this. I still fundamentally, I think about my investment journey where I want to structure my core positions around things where I think they're cheap and where there's deep value and there's an attractive risk reward and there's the price is a big discount to intrinsic value. That's ultimately what I'm looking for, and that's ultimately how these two giants in finance succeeded. Finding things at a discount to intrinsic value, and I have called out Alibaba. If you haven't watched that video before, you should check it out. That's a company, in full disclosure, I do own a stake in Alibaba. And that's an example of something that I think trades at a good discount to risk reward. That said, for Unrivaled Investing Journey subscribers, each month I call out those potential multi-baggers. In May, I called out a company trading below liquidation value that I think has 2 to 3x upside. This month, I called out another company that I think valuation is very supportive and also suggests 2 to 3x upside. And so that's the example of focus on the intrinsic value, and maybe if you think you're on a risk-on environment, you make it a little bit bigger, and that's how you tweak your portfolio positions. At least that's how I'm thinking about it. I'd love to hear your thoughts. If this video has been helpful for you, thinking about where we are in terms of the market, who's going to win when you consider Dr. Michael Burry and Cathie Wood. I mean, fundamentally, if you weren't able to catch my gist here in saying that they both can win, I'm effectively saying there's a good chance you do get this parabolic move, at least until the Federal Reserve changes course, in which case Cathie Wood, the growth stocks, get that bid, looks great again. Dr. Michael Burry looks off step. And then ultimately when the Federal Reserve does change course and or you start seeing the action in bond yields reverse, and you see that the long-term bond yields actually start reversing. Instead of going down, long-term bond yields start going up, in which case growth stocks come under pressure. If you see that sort of reverse, then at some point in the ensuing years, Dr. Michael Burry's thesis really does get proven out, and that valuations have gone bananas, and you do see a collapse in that case. There is a scenario where both are right. I'd love to hear your thoughts. Thanks so much for watching this video.